Kane Grant, who's a principal at Sinclair Wilson, is going to come up and talk to us a bit about year-end planning, CGT and super. So Kane is quite experienced in these areas, and we're coming up rapidly to the end of the year, so it's a very good time just to let Kane just go through a couple of things that he thinks is going to be very relevant for the end of the year. So I'd just like to pass on to Kane. Thank you.
Thanks, John. I can understand the reasoning for leaving tax topics to the end of the night, but given the timing of the night, I'm sure we're all going to sleep pretty well. So I'll try and work through these as quick as I can, and try and make it as informative as I can as well too. So, but the basic discussions of tonight, I just wanted to convey across, I guess, some of the key concepts regarding year-end tax planning. Given that we have only got 3 months to go before year end, and then also to concentrate on some of the concessions available in regards to superannuation, and specifically dealing with some of the CGT concessions or capital gains tax concessions, in being able to maximise some of those contributions as well too, given some of the changes with super over the many years. I think as a starting point, it's probably important to I guess contrast the difference between tax planning and also tax avoidance. And tax planning is really, I guess, maximising or looking at the most effective way within the intention of law to minimise income tax. That needs to be contrasted with the complete disregard of the law when you look at avoidance of tax along those lines. And the Commissioner of Taxation has very wide powers to amend tax returns if there is blatant avoidance of income tax legislation, and there's also no amendment period, so he can go back indefinitely, and that can certainly lead to additional tax and also significant penalties as well too. So that's always important when we look at the options and planning objectives out there. So why do we tax plan? I guess the objectives of that is purely a number of reasons. Firstly, clearly it's to obviously avoid and minimise income tax at year end. Doesn't always necessarily mean it's income tax. It can also include capital gains tax and other direct taxes along the way as well too. Secondly, cash flow planning. Cash flow is obviously the lifeblood of a business. We want to know how much tax we're paying when tax is also going to be due. And this is certainly important in any environment when it comes to commercial or any business, especially startups where they may not pay tax along the way. They get hit with their year-end tax liability. They also then enter into the instalment system, pay-as-you-go instalment system, and they find that they've got to come up with a significant amount of tax in a short period of time. So by knowing when the amount of tax is due is obviously imperative in working through the cash flow issues with any business. And only after the tax is paid, clearly we've got more disposable income to enable some wealth creation, be it some investments outside of the business, superannuation and the likes. So when we consider tax planning, I guess we look at it in two different ways. We look at the traditional approaches, which we'll go through and discuss some of the year-end tax planning methodologies. And there's also advanced tax planning, which takes into account the objectives and considerations of clients, whilst also minimising the income tax as well too. And generally we focus on three main areas, being income, deductions, and also the rate of tax payable, and that's based around the structure of the taxpayer. At the end of the day, all tax strategies should be commercially based, and that needs to be balanced against the amount of tax payable and also the cash flow needs. There's no sense in committing expenditure to save tax if you're only saving perhaps 32 cents in the dollar. You've obviously got to take a commercial approach with year-end tax strategies. So where do we start? As touched upon, if you take a a heads-up approach. Generally, you look at the trading structure. That's the start of the process. If you haven't got a trading structure that is efficient, it's quite difficult to try and control the tax on an ongoing basis. So once there's an efficient tax structure in place, then you can fold down and address some of the issues on a year-by-year basis. Clearly, if it comes to the end of the year and the tax structure is not in place there, you try and impose it for the following year so that you've got a tax structure to follow through, and then continue to work through the income and deduction items on that basis. Secondly, the small business entity concessions, that's been around for quite a period of time now, and it's imperative that the tax planning is based around whether an entity is a small business entity or a non-small business entity, because there's particular concessions that do apply to a small business entity that doesn't apply to the non-small business entity, and we'll touch upon some of those as well too. Addressing whether income can be deferred, that's also a matter to be addressed. If you can push into another year, there's some timing advantages there as well too, so that's a principle to also be touched upon. And clearly maximising deductions in the income year is imperative in trying to improve on the overall tax position. So when we come to the trading structure, there's no one fits all structure. There needs to be a balance between the needs of the client, and also there's various advantages, disadvantages with each structure. Everyone can understand a sole trader partner. Very simple, easy to understand, may not be efficient in a tax sense. Doesn't provide asset protection strategies. So you weigh that up against perhaps a corporate model which gives you a flat tax structure, be it 27.5 cents if it's a small business entity, very efficient on a taxation front, good asset protection. However, there are disadvantages in the sense of trying to extract money from that company at some point in time if you were to try and pull money out of that, if you sold a business, or vice versa with capital gains tax concessions. They really aren't ideal in a corporate environment too, because you don't get the 50% discount, and also extracting proceeds is very difficult. So you need to weigh up all the advantages and disadvantages of all of those, and we've listed a couple of items there regarding the asset protection, minimisation of income tax. Certainly the ability to access capital gains tax concessions needs to be taken into account, and also the succession and estate planning as well too for future generations. So touching upon the small business entity provisions and the eligibility criteria, this is certainly an area that we find that the adoption of most businesses, there's so many concessions available to small business entities. So a small business entity is a business that carries on a business in the income year and also has a turnover of at least or less than $10 million. And the test of that $10 million test is an aggregated turnover. So it's based on connected entities to the taxpayer, as well as any affiliates to the taxpayer as well too. So you've got to look at any entities connected to that main entity in determining that $10 million aggregated turnover test. That $10 million has gone up from $2 million. That was effective from the 1st of July of 2016. So that's going to bring certainly a lot more businesses into the arena and capture on some of those concessions that are available for small business entities as well too. We've then just listed there, I guess, how you can satisfy that $10 million test. Certainly, if you do reach $10 million in the current income year, you satisfy it, or the prior income year. If you were $10 million in the prior income year, you also satisfy that as well too, irrespective if you don't satisfy it in the current income year. So there's various tests that you can satisfy to fall within the small business arena. So what concessions are available as a small business entity for tax planning? Listed there's numerous concessions available. The simplified depreciation rules, assets go into a pool rather than being assessed at the effective tax rates. Immediate write-off of assets of less than $20,000, which we'll expand upon. Immediate write-off of business start-up expenses. So that is for the likes of setting up companies and trusts. you can write off those in the first year of establishment, whereas in the past they were capital costs. They may have been black hole and you had to assign those over a period of generally 5 years. So legislation's changed there for start-up of businesses as well too. Certainly for the corporate entities, there's a tax rate of 27.5% for small business entities in comparison to the 30% for non-small business entities as well too. A reduction in the amendment periods, what was 4 years for most entities. As a small business taxpayer, you do have an amendment period of 2 years. There are various exceptions to that. One being that if you are a beneficiary of a trust that's a small business entity, that is also a 4-year amendment period. So there are advantages and disadvantages with that. If you fail to pick up an expense, you can only go back 2 years clearly if you're a small business entity or individual. But the tax office, again, if there's no fraud or evasion, can only amend assessments for a period of 2 years. So it can go both ways. Prepayment rules, certainly that's a good planning opportunity which we'll also expand upon, and also CGT concessions as well too. So, and that certainly applies in an environment, particularly around agriculture as well too, where you've got low income but high assets. If you're a $2 million turnover, then you don't need to satisfy some other concessions around the asset values and $6 million maximum net asset value test. So that can certainly provide some concessions around planning for capital gains tax as well too. Irrespective of whether you are a small business or a business that's a non-small business, the rules around how you account for your income has to be determined around the tax ruling TR 98.1. So it's based upon whether you have either staff or equipment. How you conduct your operations generally determines whether you have to declare income either on an incurred basis or a cash basis. Having said that, expenses are generally deductible on an incurred basis whether you are a taxpayer under the small business entity arrangements or a non-SBE entity. And what that means is that you don't actually need to incur the expenses at year end as long as there's a definite commitment to pay that expense before year end. Even if you're on a cash basis, generally entitles you to claim a deduction at year end. The only exception to that is if you're under the original simplified or small business tax system back in 2005, and you remain on that system up until around 2008 and going forward. If you're on a cash basis, you can't claim expenses under that incurred basis. It's still got to be paid for as a cash taxpayer. So some of the traditional tax planning techniques, I guess, for SB taxpayers, we've covered off on some of those. The immediate deduction for start-up expenses. Certainly the the immediate depreciation write-offs remains for this year. So $20,000 immediate write-off will continue till the end of this year. So effectively there's 3 months to go before that potentially is no longer available, subject to obviously what happens within the budget. So that $20,000 write-off also applies around the pool balance, as I discussed at the start. All assets go into a pool balance and get depreciated at a rate of either 15% in the first year or 30% thereafter. If the pool balance goes under $20,000 at year end, then you're also available for an automatic write-off as well too. So certainly there's concessions there on in maximising depreciation claims. Accruing business expenses at year end, all that is just bringing forward expenses at year end, similar with not having to pay for it, but just bringing those forward in advance. And we'll touch upon those as well too. Accelerating expenditure, a good one of those is obviously the superannuation contribution. So we're talking about potentially maximising superannuation up to age-based contribution limits of that $25,000 a year, and we'll go into some of the benefits of superannuation when we talk about the CGT concessions as well too. Trading stock valuations. Each business that has trading stock under a small business is able to not elect to bring into account the opening and closing stock if it's below $5,000. So you can just ignore that increase in any movement. There's also the scope of valuing the trading stock at year end at either market value or a cost, and also a replacement value. So that also gives scope to try and work at year end some tax planning techniques around clearly what the benefits are with the valuation of that livestock. The only downfall of that is that the closing stock at year end becomes the opening stock for the following year. So effectively it's only a deferral potentially for the following year, but again with the time value of money pushing that back, it then defers that into the following year to potentially do some further work on. We talked about the accrued expenses. Some of the accrued expenses we talk about are salary and wages, and the common one with that is that a pay period may finish on the 28th of June, but you know that you're committed for 2 days to the end of 30th of June. So what that enables you to do, whilst you haven't paid it, you can bring forward into the accounts and claim a tax deduction for those unpaid salary and wages for the remaining period of time. Director fees is another one for corporate entities. What that enables the company to do is potentially to pay a director's fee, claim the deduction in one income year, but not pay it to the directors in the following income year. So you get the tax benefit to the company. The directors would be assessable on the director's fee in the prior income year, and superannuation and work cover also don't need to be paid or paid until the director's fee is paid as well too. All that is doing is effectively enabling, I guess, the company to shift some of that income across from 1 year and deferring it into the next year into the hands of the director. So that is subject to some strict requirements. Some of those is that there needs to be a shareholders resolution actually specifying that there is a commitment to pay that director's fee before 30 June. And also that generally the director's fee needs to be accounted for within 3 months of year end. Otherwise the tax officer are likely to avoid that transaction. Interest expense is also another one that if you're committed to pay interest before 30th of June, again that's enabling you to get a tax deduction as well too. Another business expenditure being repairs, maintenance, anything which enables you to bring forward the expenses, be it that you've got an invoice before the 30th of June, you don't need to pay it, but again you're definitely committed to making that payment, you're enabled to claim a tax deduction for it. The 12-month prepayment rule is certainly a tax planning strategy that is widely used, certainly in high income years that enables you to potentially prepay up to 12 months interest for small business entities in 1 year. You can't exceed a 12-month period, so for the 2018 year coming up, what it would enable you to do is potentially to prepay up to 12 months so that the service period doesn't extend beyond 30th of June of 2019 year. So it enables you to effectively get 2 years of interest deductions in 1 year. Clearly you wouldn't pay the interest in the subsequent year, but again in a high income year there's some advantages in the sense of accelerating those deductions through the prepayment of those expenses, and certainly the interest is the common one there. It is subject to the bank and obviously having the facilities to enable you to prepay those loans as well too, so that would need to be negotiated with the bank certainly well prior to 30th of June to enable those facilities to be attended to. Unfortunately, when it comes to non-small business entities, so this is for entities that don't satisfy the criteria, be it either the $10 million or generally the $10 million turnover test, you don't have the deductions that's available to small business entities. So it's very difficult to try and to reduce the taxation obligations as a non-small business entity. So I guess the issues to consider there are certainly to accelerate the expenditure, again superannuation deductions, and then accrued expenditure. So bring forward expenses in that case, but you certainly don't have the concessions available as you do with small business entities, unfortunately. So advanced tax planning, we've talked about the general deductions available to both small business entities and also to non-small business entities. When we consider advanced tax planning, I guess we're taking into account the objectives of the client and also looking at, okay, what strategies can be attended to minimise the income tax. And when we're talking in a superannuation environment, super is still a very good option in today's environment with superannuation. We've seen a number of changes over all the years. You look back to 2007, there's been so many changes over that period of time, be it on a contribution basis and also in regards to the changes that have been made to pensions and certainly to date with the changes from last year with contribution caps, $1.6 million contribution cap that can be potentially tax-free within the fund. There's a raft of changes that have come through over the number of years. But there's certainly some benefits still available, certainly around superannuation funds having assets, especially business real property. You can get that to certainly generate some tax savings through there. So a self-managed super fund can acquire a business real property within its environment without breaching the in-house asset rules. And it can be funded either via cash that's in the fund, a limited recourse borrowing arrangement, or by contributions as well into that fund to satisfy that purchase. Unfortunately, with the legislative changes, there are now restrictions though with the contribution caps. So once you've reached that $1.6 million cap, it is very difficult in essence of trying to get any excess funds into super to maximise the entitlements. But there are ways, and we'll touch upon those within the CGT concessions as well too, along those lines. But one of the benefits certainly of having property within the funds is that once a member reaches preservation age, an income stream can commence, and if they're 60, that's tax-free in the hands of that member. And certainly within that fund, it can also be tax-free in that fund, subject to what the balances are within that fund. Taxation of income streams, we have there that members between the age of 55 and 59, it's taxed at their marginal rates, less a 15% tax rebate, and 60 years it is tax-free as an income stream. So we have just a bit of a diagram there, I guess, explaining usually the concepts around how a self-managed super fund works within an environment. So we have the super fund that owns the business real property, the business, be it either siblings or the business entity, it may have obviously retirees or the siblings in there. They make rent payments or contributions to the super fund. And those rent payments are tax deductible to the fund, and they may be taxed in the fund depending upon whether it's in accumulation or pension mode at a 0 rate or a 15% tax rate. Clearly the income in the hands of the retiree at 60 years of age is tax-free, and it also then assists in the retiree supporting the income as well. So it is a great strategy, and certainly a strategy that we have seen grow since certainly 2006 over a period of time. However, there are certainly issues to consider when you look at transferring business real property into superannuation, and some of the main issues are certainly around that contribution and the caps of how much you can, what value you can get into superannuation as well. Commercial lease payments, the business will be required to make a lease payment regularly, so you've got to look at the sustainability of that business servicing that lease payment to the superannuation fund. You don't want to make it very difficult in that business and put pressure on it if it's got to pay substantial lease payments to the super fund. So that needs to be taken into account, as does the death of the member, estate planning positions around that. Certainly the stamp duty implications as well could be a significant cost. And certainly the capital gains tax implications as well too, if there's a transfer from one party into the super fund, that needs to be reviewed. So on the backing of the capital gains tax, it is a complex area, and especially with significant value tied up in the assets. And it is important to structure the assets correctly up front to make sure that there is the concessions are available potentially if someone does either sell an asset or want to take advantage of the capital gains tax concessions, so they're not paying significant amounts of tax if they do sell an asset. So what are the concessions that need to be available, or the basic conditions to be able to access some of those concessions? And two tests. Either if you're a small business entity, that is one of the tests that you can satisfy. If you're not a small business entity, then you do have to pass what's called the maximum net asset value test, and that's $6 million. So if you don't reach the $2 million test, so if you exceed the $2 million test, you can still pass the basic test if your assets of the taxpayer and entities connected with you are less than $6 million. Having satisfied that, the asset also has to be an active asset. So an active asset is an asset that's used in a business connected with the taxpayer. So clearly, if there's a business real property that's used in conjunction with a business, then that's going to be potentially an active asset, and the capital gains tax concessions would normally be available to those concessions as well too. Active asset is dependent upon whether it's held for 15 years or less. If it's held for more than 15 years, as long as it's been active for 7.5, you will get that concession. If it's held less than 15 years, then it has to be active for at least half that period of time. So, 15 years is certainly a good concession. 7.5 years out of 15, doesn't matter what you do. Once you reach 7.5 years, you can rent it. It's still an active asset over that period of time. So once you satisfy the small business concessions, then this is where the concessions really start to kick in, and the minimisation of income tax. So the choices to apply the small business concessions usually scale down from the 15-year exemption to the 50% active asset reduction, rollover relief, and also the retirement exemption. So if we look at a case study, this will sort of tie in some of these concessions. So we'll work through these quickly, and this will sort of draw it all to a conclusion. So we've got Aaron and Jane. They're both 53 and they own a factory, and that's valued at $1 million. They have no bank debt. They've owned the building since 1995. It's used in their business, carried on by their family trust. The trust established in 1990. It's only distributed distributions to both of Aaron and Jane. The trust is a small business entity. It's been generating profits of around $200,000 a year. So they decide to transfer a factory in specie to their self-managed super fund, effective from the 1st of July of 2018, to take advantage of the concessional tax environment. The gross capital gain on the transfer is around $700,000. After applying the capital gains tax discount, you're looking at a capital gain of $350,000. So given that the trust is a small business entity and has only made distributions of income to Aaron and Jane, who own the factory, that building will be determined to be an active asset, and that's because Aaron and Jane have received at least a 40% distribution from that trust. So under the pattern of distribution control test for capital gains tax purposes, they'll be connected to that asset, so they'll be able to apply the concessions available to that capital gain. So they apply the CGT small business relief measures to reduce the capital gain, and that reduces it to nil. But as they're less than 55, that needs to be rolled over into a complying super fund. So because it's a $1 million property, the contribution is sourced from the following. So because they're 55, everyone's got a maximum age-based contribution of $25,000. So you've got two lots of $25,000 being $50,000. And also by applying the non-concessional contribution cap of $100,000 each and the 3-year bring forward rule, they can both contribute up to $300,000 in 1 year. So there's $600,000 through the non-concessional contribution cap, plus the two lots of concessional contributions of $50,000 there each. They can also then apply the retirement concession amount of $175,000 each because they've owned that property jointly. So therefore the retirement concession is $350,000. So they can avoid the capital gains tax transaction. The $1 million can potentially be transferred into the fund by applying those concessions. Capital gains tax certainly doesn't apply. Stamp duty, clearly that's a matter that would need to be discussed on a legal front, but certainly the understanding is that in South Australia come 1st of July of 2018, stamp duty is being abolished from non-residential and also non-primary production land. So it would appear that stamp duty shouldn't apply in those circumstances as well too. GST would need to be reviewed, subject to whether the super fund's going to be registered for GST. If it is, GST shouldn't apply also. So it should be a fairly good win situation for the client in maximising some of the concessions moving forward in a tax concessional environment, and also provide some opportunities also from the estate and succession planning point of view and asset protection. So once the property is transferred in the super fund, the trust signs a lease providing for annual rent of $40,000, and the results as follows. There's a $25,000 tax deduction for each of Aaron and Jane in the 2018 year. Because the super fund's in accumulation mode, it pays tax of $7,500. There's an annual rental deduction of $40,000 deductible to the trust. The super fund will also pay $6,000 tax whilst in accumulation mode on that rent. Aaron and Jane's taxable income, which was $100,000, is reduced to $55,000 each. So the tax savings in the first year would be around $32,000. The super fund would pay tax of $13,500. So the tax savings in the first year would be around $18,000, with $9,000 savings year on year if they don't make the $25,000 contributions. And after that, obviously, Aaron and Jane would need to contemplate, preparing new wills to take into account that they no longer own that asset as well too. So there need to be follow-up in regard to making sure that the passing of that asset takes place in accordance now that they don't own it, that it's in the super fund. But not all assets are, in regard to the transfer of property, a lot of the concessions can take place if an asset is sold. So I've got a case study here, number 2, which deals with a situation perhaps where Ian, he's 62, he's decided to retire. So he sold his business in August of 2017 for $1.1 million. And that sale is going to trigger a capital gain of around $800,000. So the basic CGT concessions are going to be satisfied for Ian because he's over 55 and Ian's going to permanently retire. So Ian is able to disregard the 15-year exemption and disregard completely the capital gain of $800,000. So Ian can contribute the entire proceeds of the $1.1 million into his super fund without breaching the contribution cap. And that would be achieved by allocating that against his lifetime CGT limit of around $1.45 million. Now, if Ian didn't proceed with the transfer of those proceeds into the super fund, all that he could contribute would be $325,000, being the bring forward rule of the 3 lots of $100,000 plus the $25,000 concessional contribution. So Ian would be left to pay tax on the remaining funds of the $775,000, which would be taxed at his marginal tax rate. So certainly there's also opportunities if there's business assets that are sold of applying the small business concessions, utilising the cap that is there, being the lifetime cap, and getting additional funds into a super environment that potentially could also be tax-free. And certainly in Ian's case here, where he's over 60, could commence a pension and also draw out tax-free funds. Some tips and traps to obviously be aware of under these situations. The $2 million turnover test is retained for CGT concessions. Small business entity, the turnover is the $10 million, but for CGT concession purposes, it is $2 million. So that's certainly an important area that it can be overlooked. Payment required to be made from trusts and companies. So any capital gain that is made by a trust or a company, a payment does need to be made out of that entity within 7 days. So in situations where there's an in specie transfer of property, because there's no consideration, a payment still does need to be made out of that within a 7-day period of time. So that needs to be taken into account as to how those proceeds are going to be paid out from those entities. This is a bit of an oxymoron. CGT Small Business Relief Concessions, no actual retirement is required under the CGT Small Business Relief. However, with the CGT 15-year exemption, there is a requirement to permanently retire. So that doesn't need to be everlasting, but certainly to apply that concession, there needs to be a demonstration to the tax office that you have retired and aren't intending to go back into the workforce, a reduction in work hours, significant change in what you do to apply that concession. And certainly finally the CGT rollover relief does enable you to defer a capital gain for 2 years. Even if you aren't intending to find a replacement asset, you can defer it for 2 years and not pay any tax. And then come 2-year period of time, if you don't find a replacement asset, you then pay the applicable tax on that capital gain at that period of time. But certainly that can be useful for someone that is perhaps 53, 54, where they would otherwise have to put money into superannuation. You apply the CGT rollover relief for 2 years. You then turn 55, you no longer need to put the proceeds into superannuation, you can take it and still apply the concessions. So there's some cash, some savings there and certainly worth considering as well too along those lines. So that ends my presentation. I try to get through that fairly quickly given the night. Any questions? Okay, thank you.